Thank you, Sarah, for joining us today. Now, for our listeners, tell us a little bit about your experience and the exception of Bond Financial.
All right. Well, I'm actually a Tassie girl. I was educated in Tassie, grew up there in Tassie, and then I moved to Wollongong. I worked in a top tier firm at the time. I then worked in mid tiers, and then I went to a smaller firm. And I've actually been in accounting for 20 years. And about 2.5 years ago, I was fired for taking a holiday for my birthday. It's always a good conversation starter. I actually really love sharing that story because a lot of people are like, "What?" But honestly, it was now that I'm here, it's exactly where I'm meant to be, and I love what I do. I love my business, and whilst I'm an accountant, I'm really in the customer service business. I see a lot of clients that are struggling with understanding their account, understanding what needs to be done. So yeah, I love what I do.
Can you run through the different facets of being an accountant?
Yeah, so I guess our business, and what I often say is there's sort of two parts to what we do. There's the ATO side, so there's all the lodgements that you need to do, your activity statements, your tax returns, all the things that are past looking, they're backward looking. They've already, that year's been run and done, and there's nothing we can sort of do to really fix and unstitch that. The other side of our business is then what we call outsourced CFO or fractional CFO. So that could be either helping you to run your business, so it could be helping you to do your bookkeeping, your payroll, accounts receivable, payable, or if you do have that team, it might be then us just helping to supplement that, whether by doing monthly meetings, sort of keeping you accountable to what we've been talking about, what you were supposed to be doing, but also giving you time to actually sit back and work on your business rather than just being in, day out, and not actually focusing on the bigger picture.
What do you love most about being an accountant?
It's actually the people element. And that's, I love helping people with, and I understand that unless you've been like me and you've been to university, you've then done postgrad, a chartered accountancy qualification, this stuff is not taught in our school system. It's not taught in our education, and a lot of people just do not understand the fundamentals of tax, of finance, how to manage a credit card. And so I really like coming in and being able to basically translate a lot of that legislation and the wording and the confusion and frustration around a lot of that sort of things.
And policies change every year.
Because we have a budget, so the budget will always bring out something new. Although this year it was pretty uneventful. But that certainly does. So that can make changes. You have elections that then create changes. So even coming into 1 July this year, there'll be a couple of changes around our super rates going up for the last time, and yeah, so there's always things to keep abreast of. So that's where it's good to have a really good relationship with your accountant, because they will know, or they should know, what changes are coming up and what you should be aware of that could directly impact you and your business.
And I think that's the difference between what makes a good accountant versus one that's not.
I would say that's probably the biggest complaint we get from new clients is they're dealing with a reactive accountant rather than a proactive accountant. It's probably the number one thing that I see pretty often.
Now, let's talk about tax and properties. Is the main residence always capital gains tax free?
One of our biggest tax carve outs is the main residency exemption for your home, so your primary residence. Now, everyone probably assumes that is 100% of the time, you're always going to get that on your main residence. However, that's not necessarily the case. So, the one time where you won't get 100% exemption is if you buy your home, you don't take vacant possession. So, you buy your home, there's a tenant already living in it, you settle before that tenant moves out. If that property, your home, has been rented initially from the day that you settled and bought it up until the point you move in, you will lose 100% main residency exemption. So in that case, you're always going to have to pro rata the sale of your property. Now, you might live in it for 30 years, so that the pro rata ship is going to be absolutely minute. If there's only 6 months out of 30 years that was rented, but because it was rented before you moved into the property, then that you will get caught with the need to prorata your main residency exemption. So if you are looking at that, look, a lot of properties are tenanted before they're sold. If you're looking at wanting to make sure you maintain your residency exemption, then you would look to only settle on vacant possession. So you would wait for the tenant to move out, delay settlement, and then only settle once they have actually left the property.
For our listeners that aren't familiar, what is capital gains?
Misconception around that it's a separate tax, that it's it sits in its own sphere, and there's a different tax rate and all this sort of thing. There's actually not. It's really it's an umbrella for a type of tax and a tax event that occurs in relation to capital assets. So it's not a different rate of tax. If you do sell a rental property, then the profit that you make on that property, which is either it's your revenue less, so your sale price less your cost base, and any other expenses that go into that. But essentially, the amount of money that you make on that property, it then just adds to the rest of your income, whether that's employment income, whether that's sole trader income, and it will just get taxed at whichever marginal rate you end up in. So there's no additional rate, there's no special rate. It's just whatever your bracket is at the time in that financial year.
What happens if I've moved out and I have two properties?
Under legislation, you can only have one main residence at any one time. That's the way it's written. That's the way the ATO allows for you to have an exemption. You only have an exemption on one main residence at one point in time. Now, the only time that you can get away with that in a way is that if you do buy a property, and you've been selling your current residential home, you have a period there where the ATO says, well, if you have done everything in your power, you've put your property on the market, yes, you found your perfect home and you've moved in before you sold your previous main residence, they will give you a gap. They will give you an amount of time to sell your old home and still be able to claim full exemption whilst then being eligible for full exemption on the new property. Look, that in saying that, they probably wouldn't give you 12 months or 2 years. I'm sure there would be a cutoff point. Not that it's necessarily written anywhere, but there's always ambiguity with some things like this. But they basically say, yes, you can, in that instance, you can have two, as long as you're actively trying to sell your previous property, then you'll be able to sell that completely capital gains tax free, and then the new property will then retain the main residency exemption from the day that you moved in to the new property.
I often hear about this term, the 6-year rule. Can you explain what it is and what it means?
Like, it's one of those things that doesn't get talked about a lot, but the 6-year rule is essentially where you have, it could be your main residence, you move out of that property and you can rent it for up to 6 years, so not over, it's up to a 6-year period from the date that you moved out. But you actually can rent it for 6 years and then still sell it before the 6 years is up, completely main resident, like capital gains tax free. And you can still rely on the main residency exemption. Now, you can also reset that 6 years, so you can move out of your property. Now, again, coming back to our previous question, as long as you hadn't moved into another home that you were claiming as your main residence, so you would move out of the main residence, you would go and rent somewhere yourself, maybe you moved overseas, you might have been moving back into the parents. As long as you're not living in another home that you're saying is your main residence, you get 6 years. You can then move back in 5.5 years, reset the 6 years. So move back in, you might live there for a few more years and then you move out again. You could essentially keep rolling that 6 years over multiple times and still sell the property after 20 years, and it will be completely tax-free from a main residency exemption point of view.
Let's talk about property investing and tax. Can you explain some of the most common structures that investors use? And specifically, let's talk about family trust and why it might not be what it is made out to be.
Yeah, and I guess maybe to preface, income tax and accounting on investment properties. I've been an investor for 16 years, so I've got 5 of my own properties, and I walk the walk and I talk the talk because I've been through this in every which way you can possibly imagine. And yeah, look, when it comes to structures, There was a change not so long ago, particularly in New South Wales. Now, that's the only problem when we're dealing with the country as a whole. I have to actually talk about New South Wales in this instance because other states have completely different rules. So in New South Wales now, as of recently, if you use a discretionary trust, a family trust, then there's no land tax exemption for property. Now, that means, so generally speaking, as an individual or other entities, you're actually eligible for a land tax exemption of nearly $1 million in New South Wales. Again, that is different state by state. But if you now use a discretionary trust or a family trust for property ownership, you don't get that exemption. So you literally pay land tax from the very first dollar of that property's value.
What is land tax?
Yeah, so land tax is essentially it's tax on the land, so it's government tax on land. Now, when we say the value, it's actually when you think about a property, you go, well, I bought this property for $500,000, I'm going to pay land tax on the $500,000. It's actually not on what you paid for it, it's on the value of the actual space of the land. So, particularly when people buy apartments, the actual land space in an apartment is tiny. So, it might be the actual land value of an apartment is $50,000 to $100,000 purely based on the floor plan. Even though you paid $500,000 for it in Sydney, you probably can't even buy an apartment for $500,000. But so it's actually on the land size as opposed to the market value that you paid.
How do you calculate land tax?
Yeah, and that's index. So this is all a government calculation. So essentially, the Office of State Revenue are in charge of land tax, and that rate is often increased, whether with CPI or it does go up when they see that land values have increased. I know there's some years where there's been huge jumps in land tax. But that's a calculation that they once you're registered, then they do that calculation and basically send you an annual assessment on your land tax to pay.
So is land tax paid annually?
Now, in New South Wales, there is actually a land trust that has been set up. So the New South Wales government has actually set up a trust now that it's more like a hybrid trust. It's a bit of a fixed trust in that it basically skirts around those land tax exemptions, or the land tax inability to access the land tax threshold. So that is something that you can consider. But look, generally speaking, yeah, trusts may not be what they're cracked up to be when looking at property investment. But I know it's a very hot topic.
Okay, so why would somebody use a family trust model?
Look, mostly, and trust in general, mostly people use trusts for one, asset security. Depending on how you structure the trust, it can give you good security from depending on what's in the trust, but also from you and your ownership of whatever that asset is. But also from more tax efficiency. That's what trusts are known for. Number one is tax efficiency because it allows you to distribute to more than yourself. If you make it into a family trust, you can then distribute to your immediate family members who might have very different tax rates than you. So that's traditionally what they're used for, and certainly they were used for property in that way up until only a few years ago. But yeah, they put a stop to that. So if you're thinking about buying property, doing it in a discretionary trust is not necessarily the way to do it.
I think it's also important to note that there's so much content out there in the marketplace, and every video that I've come across, it's always like open up a trust, this and that, and blah blah blah. But I think it's important that each individual goes out and gets professional, individualized advice, because it's not always going to be the right one and the right fit for you personally.
And look, if it was as good as it sounds, we'd all be doing it. I'd be doing it. So yeah, it's always best to get a qualified opinion so that at least you've got all the right information and you can make an informed decision.
Are there any other structures that are commonly used?
No, they would be the main ones. I guess as far as structures for property go, generally, look, companies, you won't find a lot of accountants recommending companies for investments in general, and the main sole reason for that is that companies don't get the 50% discount. So as an individual and even as a trust, because a trust isn't a separate identifiable entity, it's a look-through entity. So the people that get taxed in a trust are basically the beneficiaries at the bottom. So as an individual, then if you sold a property, and as long as you've held it for longer than 12 months, you will naturally get a 50% discount on the profit that you've made on that property. If you're a company, you do not get that. So as an accountant, you'll very rarely see people recommending companies for that exact reason.
What type of investor would use a company structure?
The only time you may consider a company is if you're a professional investor, if you literally buy flip houses, whether you're a professional investor and have many properties and you're basically running a rent roll. If you're in the business of being a property investor or a developer or something like that, then what actually happens though with those purchases, they're now on revenue account. So they're no longer on capital account. So we're probably getting quite detailed now, but a company is only going to work out for those people that are literally doing this as their day-to-day job. It's actually their business of being in property. If you were just doing this as, you're doing it as a passive investor, as I am myself, then I don't use a structure for my properties.
From an accountant's perspective, when it comes to investment properties, what is important for our listeners to know when it comes to timing and initial repairs?
Yeah, this is one I probably see the most. I think out of all the questions that I get or out of people coming to me for the first time with their return, they're like, oh, I bought an investment property, I've got all these expenses to claim. And then I have to kind of rain all over their parade and say, I'm sorry, but we can't claim those. So the ATO is very specific when it comes to what we call initial costs and initial repairs. So they are essentially anything that you've done to the property before it was really available for rent and was tenanted to the very first tenant. So I'm not talking about between tenancies after one tenant's moved out and you do some renos and then maybe someone moves in 3-4 months later. It's actually from the moment that you buy it, if you do a whole bunch of initial repairs and renovations, whatever they might be, the ATO specifically classify them as initial repairs and they won't be either deductible straight away and they won't even be depreciated in your return. They'll have to be added to the cost base of your property. So you won't lose the deduction at all. You will get the benefit, but you'll only get the benefit if you sell the property. Yeah, so that's a big one. And I see so many people that, a lot of people buy a property and they're like, oh, we'll spruce it up, we'll get some extra rent per week and we'll make it feel nice for the first tenants. But all of those initial repairs are going to you're going to get caught by the ATO's legislation on that, and it will be added to your cost base. And there's not a lot we can do as far as depreciating or expending them. The only option you would potentially have would be to do a tax depreciation schedule that you actually speak to a qualified surveyor for those. Although they sound like we should be able to do them, as an accountant I actually can't do a tax depreciation schedule. But that would be something to definitely investigate if you've done a lot of renovations and improvements to the home before someone moves in.
Okay, so basically don't do any major renovations straight away, but speak to a valuer to arrange a tax depreciation schedule, is what you're saying.
That's right. Because it's also going to depend on how much you're going to spend or how much the property. Again, with tax depreciation schedules, it depends on how old your property is. So it needs to be at least less than 40 years old. If it's over 20 years, you're probably starting to lose the maximum benefit from a schedule. But then depending on what your renovations look like and the quantum of those, then it could definitely be worthwhile you doing a tax depreciation schedule.
What is deductible when it comes to equity?
Your mortgage in the principal and interest is not deductible. So your mortgage repayment, so the amount that comes out of your bank account, if you're on a variable mortgage, you only get a deduction for the interest, not the repayment. So I do get this question from time to time and it has come across my desk probably more than I thought it would. But yeah, the actual principal repayment, the actual mortgage repayment in totality that comes out of your bank account, that's not the part that you're going to put in your tax return. It's only the interest component that is deductible to you and will go on your tax return when you put in your rental property information. So that's probably the biggest, chunkiest one. I think what you need to also make sure of is people will have agents managing, which I recommend, but also having them pay as many things as you possibly can so you don't miss anything. You know, we quite often see clients that'll have an agent, but then they pay some things on the side themselves and then forget that they've done that. You know, it might be insurance, it might be even some of their strata or their rates. So it's just making sure that you're really documenting and keeping track of everything really well, whether that's in separate email folders, whether you've got like a Dropbox or some sort of Google sheet that's you're sharing this and saving it all into. It's just making sure that we're actually keeping track of everything. Because the ATO, they say it every year, but they always like to keep close tabs and close eyes on rental property deductions in particular. So if you do have a rental property, it's always good to be very organised, and succinct with your information.
What other things can't you claim?
One thing in relation to the interest as well, which people don't tend to think about, is a lot of people like to release equity from their properties, which makes sense. The problem is, depending on what you do with that equity, will determine whether it's deductible or not. So, you know, often people go, well, I've got a rental property, that's deductible. I'm going to take out the equity and then I'm going to go and spend it on a boat. It's like, yeah, but now that equity you've unlocked, and even though you've increased the loan on your rental property, we can't deduct the amount you took out to buy the boat because that boat is not a deductible expense. Therefore, the interest is not deductible. Therefore, the portion of that loan that's now on the rental property, that's not deductible debt. So that's something to be very aware of because I do see people do this quite often, or they don't necessarily get the right advice, you know, from actual their financial experts and people they're dealing with. So that's one thing to be, for that debt to still be deductible, it must be spent on a deductible purpose. So regardless of, because even though the property is a rental property, that's fine, but you need to spend that additional equity on something that also creates income that would be deductible for you.
So, what if I was starting a boat business?
Um, Look, you could probably make that work, but then obviously you're going to have a kind of a cross charge between, you've got an individual here that's got a loan in their name and they're paying interest. You then got a business over here that's then running this boat chartering company. So you're going to have to actually have the two sort of connect. So you actually have to show income in the individual person's name for the, you know, for basically the company to claim the interest. So yes, you could do it. It would get a little complicated. Not ideal, but you could you could do it. But you could go out and buy some shares. You could go out and put money in the stock market, and as long as the money that you've used from the equity is income producing, it's gone towards an income producing purpose, then it will still give you the ability to deduct the interest. But in saying that, you wouldn't deduct the interest against the rental property. It would have to sit separately in your tax return as, say, an interest or a dividend expense against that investment income. So you would have to actually split it up and cut it out. So the more that you pull things out of equity, it can just make it a bit of an admin nightmare because you've then got multiple places that you have to sort of report the numbers.
Thank you, Sarah, so much for joining us on our podcast today. And I'm sure our listeners will get so much value from listening to your advice and your knowledge. And thank you for sharing that.
Thank
Thank
you.
you.